Let's dive into the two basic pillars of investing: stocks and bonds. While both are securities, the relationship you have with the issuer is different. When you buy a stock, you literally become a shareholder, a part owner of a company. Companies issue stock to fund growth. As an owner, your returns rely on the stock price going up and non-guaranteed profit payouts called dividends. This path involves the highest risk. If the company goes bankrupt, shareholders are the last to be repaid. However, this high risk is rewarded with the potential for those substantial, indefinite, higher returns. Now consider a bond. When you buy a bond, you're making a loan to the issuer, a government or a corporation, making you a creditor. They promise to pay you fixed interest payments, called coupons, and return your principal on a set maturity date. Bonds provide much greater stability and predictable income, but offer lower returns. Crucially, bondholders have seniority over stockholders. They are repaid first during a liquidation, making bonds the safer, fixed-term component of your portfolio.
In finance, volatility is the measurement of how much and how quickly a security's price changes over a given period. It is often visualized as the degree of variation around the average price. High volatility means the price is experiencing dramatic and unpredictable swings, making the asset inherently riskier. Low volatility means the price is relatively stable, suggesting less risk in the short term. Volatility is typically quantified using past data, known as historical volatility, but traders also focus on implied volatility, which represents the market's collective forecast for future price movement. Understanding volatility is essential for gauging market fear, assessing risk tolerance, and accurately setting the price for complex financial instruments. What are stock options? Stock options are contracts that grant the holder the right, but not the obligation, to engage in a stock transaction at a fixed price by a specific date. They are derivative instruments, meaning their value is derived from the price movement of an underlying asset, typically a common stock. The two fundamental types are call options. Give the buyer the right to buy the underlying stock, for example Tesla, at the specified price, strike price. An investor buys a call when expecting the price to rise. Put options. Give the buyer the right to sell the underlying stock at the specified strike price. An investor buys a put when expecting the price to fall. An investor pays an upfront fee, called the premium, to acquire this right. Options allow for leverage, meaning investors can control a large block of stock with way less capital than buying the shares outright. But they expire worthless if the stock price doesn't move favorably. The premium to pay for an option is composed of two parts. Intrinsic value. This is the immediate profit if the option were exercised. Only ITM options have intrinsic value. For a call, it's the stock price minus the strike price. Extrinsic value. Time value. This represents the possibility that the option will move ITM before expiration. It is directly influenced by the time remaining and by how much the stock is expected to move until expiration. Options are categorized based on T difference between the current stock price and the strike price, a concept called moneyness. And there are three categories. In the money. The option currently has intrinsic value. For a call, it's the stock price minus the strike price, and the contrary for a put out of the money. The option would expire worthless if exercised immediately. Stock price is below the strike price for a call, and vice versa for a put.